my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. At the start of May, the market was moving down through a fairly free zone between the May 2011 high at 27,330 and the August 2011 high at 25,195, when prices jarred to a halt at the round number of 26,000. There followed 2 weeks of testing until prices gave up on the downside. In the process, the market created a small double bottom and broke back up through the medium moving average, currently at 28,575. However, this move up led to not only a double bottom but also a shooting star pattern, type 1 bearish, 3 weeks ago. Now, before going further, I would like to expand on a theory I have about why the market halted in the 26,000 area when there didn't seem to be any signs of support located there. I laid out the basis of it 5 weeks ago and repeated it over the intervening weeks, including now today. You'll see how relevant it becomes when I discuss this past week's action. Anyway, it all relates to the August 2011 high at 25,195. This is an interesting level. Other than the fact it was a significant high in the past, it was also the approximate start level from where the original huge rally in March started from and its subsequent ghost highs. Hence, we would be back to where the market started way back in late February, and it is the market's approach to these levels that prompted a premeditated response at a higher level, indeed at the next higher level, the next round number level of 26,000, in anticipation of this very important 25,195 level being tested. Anyway, back to the shooting star pattern, type 1 bearish. Eventually, that initiated a move lower 2 weeks ago. On Monday last week, prices punched down through and closed below the key 26,000 level, with the first of 2 consecutive bearish open and close black Mariposos. The second of these, on Tuesday last week, tested down to, yes, you've guessed it, down to the key 25,195 level, briefly piercing it, but finishing up closing over it at 25,215. How close can you get? The rest of last week was spent in indecisive patterns, going out to the 3rd degree of indecision last Friday, as the market contemplated trying to push down through this key 25,195 level and closing below it, ideally consecutively closing below it. I have a suspicion that there was some significant stop hunting going on from Tuesday to Friday last week on the downside, in the end all in vain. This week prices have moved back up a bit, but are now constrained by the support that has become resistance at the 26,000 level. I further suspect that the move lower, the attempts lower, are not over yet. Below this, the next support level ought to be the late February low at 23,865. However, a new factor is entering the frame coming up from below, and that is the rising long moving average, currently 24,190. This will increasingly become a larger factor, initially to support the market, but it may also end up being a potential trigger for any move lower. You see, a little below, we now have a potential target X2 for the potential action of April today being a possible bearish halfway hesitation. This is in many ways a prospective target below, but it is a potential one should 25,195 be properly broken. LME 3-month zinc. There continues to be a lot of interesting things going on here right now. First off, I'd like to set the context. Now, I'd previously spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these, I noticed a significant pattern still in operation, plus a second pattern that was forming, shall we say. The principal pattern was the 2015-2020 bullish Andrews pitchfork, and the most recent events involving this pitchfork. Now, 3 weeks ago, the market moved up to the combination of the middle time, currently 39.70, plus the March to May 50% Fibonacci line at 39.96, as well as the then flatlining short medium moving average, currently at 39.32, where prices halted, hesitated, and then headed back down again including yesterday, with a new low for June. Now, prior to this, in mid-May, the market had dropped down to the combination of the rising long-moving average, currently 35.89, and kissed the lower trend line, currently 35.26, of the second large pattern that was in formation, the lower trend line of a very large ascending expanding wedge pattern. After doing this back then, the market immediately reverted back up again. This second pattern does require some work, as it would require you to ignore part of March's action, specifically the top of the huge spike on the 8th of March, which was pierced, but which did not see a close over the upper trend line of this 2020 to date ascending expanding wedge pattern. Anyway, looking back now at the more recent action, it seems for the moment that the market is capped overhead by the short stroke medium moving average, the middle tine, and the 50% Fibonacci combination, whilst below it has been supported by the combination of the lower tine and the long moving average. Observe that these lower supports are rising, if slowly. So what are the forces that are impinging upon this market? Well, the recent moves up and now down still have some other, in one case larger forces impacting prices. The first one I'd like to look at has not really been tested as yet, though it has seen some market action. Even then, I am still not sure if it is a valid force. It is the prospective March to April bearish shift pitchfork. This pitchfork does or has not had either the lower or upper tine tested as yet, and until it does, it will remain prospective. The one tine that has seen action, especially over the last week and a half, is the middle tine, currently at 34.65. Additionally, I can see an argument for a new bearish pitchfork, Andrews or Schiff, I'm not sure which, but for the mid-April to late May action. But I think it's a bit early on that right now. Right, this brings me now to the most recent action of the last 3 sessions. We've seen last Friday a breakdown through the long moving average and a close below it. But though the market also broke down through the lower trend line, currently 35.26 of the 2020 to date, very large ascending expanding wedge pattern, there was no closes underneath it. Additionally, yesterday was an indecisive doji cross, and so far today we've seen prices rising. Hence, could the last 3 sessions be in formation a 3-day bullish morning doji star pattern? This actually pattern may help in finding a solution to the question I laid out last week. You see, the action since mid-April today opened up the possibilities of 2 patterns, a possible double bottom or a possible bearish halfway hesitation. It is too early on either pattern to see which may be finally formed, but it is worth remembering and considering. Finally, let's look at that big ascending expanding wedge pattern on its own and what it may mean. Well, for starters, such patterns are usually not bullish. Just over half the time they end up with a bearish break lower. However, if the price breaks upwards, the quality of the move higher is usually seen as better than any break lower. We're not there yet, but with all these possibilities forming and not forming, I thought you ought to have some idea of what may happen just in case. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.